Hey everyone, welcome to This Explainer. Today we are going on a serious, deep dive into the recent, pretty dramatic shift we've seen in the crypto markets. We're going to dissect the exact anatomy of a breakdown. Specifically, we're looking at why Bitcoin broke below that absolutely critical $60,000 threshold, and honestly, more importantly, figuring out where future price stability might actually establish itself. So if you've been glued to the charts wondering, what on earth just happened beneath the surface? Well, you are in exactly the right place.
Here's our roadmap for today. We'll start off with breaking the 60K barrier, look at what actually caused the crash, then explore the liquidation avalanche, search for new floors, and wrap up with how we can navigate the market safely. Let's just get right to it.
Okay, let's dive into this with Section 1, breaking the 60K barrier and looking at that initial fracture.
$60,000. It really isn't just a number. It's a massive, massive psychological anchor in the market. We have to understand this initial fracture before we can really grasp the full collapse. Large, round numbers exactly like this one, they become huge focal points. Traders heavily rely on chart psychology, placing massive concentrations of buy orders, sell orders, and those protective risk stop losses right at these levels. It basically becomes a line in the sand, a boundary where the market collectively decides, okay, this is the immediate value of the asset.
And that boundary is exactly what we call support. It's a specific price level where buying interest is historically strong enough to just overcome selling pressure, acting as a literal floor that stops the price from falling any further. But order books are ultimately driven by the core interaction between supply and demand. So breaking 60,000 simply means that the sheer volume of active sell orders completely exhausted all of the available buy orders waiting at this critical floor. The demand just dried up entirely, and gravity took over.
Which brings us to Section 2, what caused the crash? Let's zoom out and look at those external pressures.
So what actually tipped the scales here? Well, it wasn't just a single event. It was honestly a perfect storm. On the macro front, we had US CPI hitting 4.2%, which forced central banks to keep rates high, heavily squeezing the overall cash available for risky assets. Geopolitically, tensions between the US and Iran triggered an immediate flight to safety. Investors were basically fleeing volatile assets for traditional havens, like cash or gold. Then, institutionally, sustained capital outflows from ETFs simply starved the spot market of hundreds of millions of dollars in buying power. And mechanically, it was just brutal. Monthly options and futures expiries concentrated massive trading volumes right at that 60K mark. It was an absolute pressure cooker.
But the pressure didn't just come from the outside. It came from adjacent markets, too. Public companies that are heavily exposed to Bitcoin often act as market proxies. If their stock prices weaken or if they face structural issues, it creates this really dangerous negative feedback loop. Investors see the proxy struggling, they lose confidence, and that directly hurts the underlying cryptocurrency, draining even more buying strength from the market. And once that buying strength was drained and the support cracked, things moved incredibly fast.
Let's shift gears a bit. Section 3, the liquidation avalanche. We're going inside the engine room of the market breakdown. If you've ever watched a chart just completely fall off a cliff, this is the exact 5-step sequence that plays out. Step 1 is sentiment deterioration. Basically, macro shocks hit the news, and the fear index swings into extreme territory. Step 2, large institutional and retail traders decide to minimize their risk, triggering a wave of ETF and spot selling. Step 3 is the actual battle. The price drops down to that 60K boundary, and buyers desperately try to absorb the selling volume. But in Step 4, the breach happens. The selling is just way too heavy, the price slips below 60K, and bam, it immediately triggers automated stop-loss orders. Finally, Step 5, the market enters a total freefall in search of new support, cascading downward until it finally finds a recognized value zone.
The mechanics of this freefall are really driven by something called cascading liquidations. Look, a lot of traders use leverage, right? They're borrowing funds to trade larger positions. When a leveraged trader's position drops past their strict risk limits, the exchange doesn't call them up to check in. No way. Automated engines step in and force sell their Bitcoin instantly, sometimes literally in a matter of milliseconds, just to cover the debt. This dumps massive amounts of Bitcoin onto the market, driving the price even lower, which then triggers the next guy's liquidation and the cycle repeats.
Let's move to the timeline and see how this builds. Watch how incredibly fast this domino effect ripples across the entire crypto ecosystem. The initial event is that psychological drop below 60K. Just minutes later, we get the first order effect. Automated margin calls and forced liquidations hit leveraged long positions for hundreds of millions of dollars. Hours later, the second order effect arrives.
Raw panic sets in, and everyday retail spot traders just dump their holdings because they're terrified of a deeper crash. By the time we measure it in days for the third-order effect, technical indicators like the RSI are completely crushed into oversold territory, and long-term moving averages flatten out into a bearish trend. It is a rapid, brutal sequence of events.
Now let's slow the pace down a second to evaluate the aftermath. Section 4. Searching for new floors.
So, the dust is beginning to settle, the dominoes have fallen, and the market enters this highly tense phase of heavy indecision, which leaves us with a million-dollar question for anyone managing risk or allocating capital right now. Where exactly is the market's new floor? You see, once a major level breaks, the price keeps dropping until it hits a zone filled with a really high density of new buy orders. We need to identify exactly where those buyers are highly likely to step back in. Based on verified order book data and historical support zones, here is exactly what you should be watching. The immediate support range sits right between $58,500 and $57,300. Now, if that fails, there's a deeper value zone where institutional and long-term buyers might decide the asset is finally cheap enough to accumulate. That sits around $54,000 down to $53,400. However, pay very close attention to the critical risk boundary at $57,790. If the market fails to defend that specific point, it literally opens the door to a drastic accelerated drop toward the 200-week simple moving average, which is sitting way down near $50,000. And this brilliantly illustrates the absolute greatest danger when tracking these new floors, confusing a false rebound with a true bottom. A false rebound is the sudden, deceptive price bounce off a support floor. It looks like a recovery, but it completely lacks real underlying demand. A true bottom, on the other hand, is boring. It's a lengthy, grinding process of consolidation and heavy indecision. It just takes time for the market to stabilize and for buyers to truly regain control. All right, Section 5, Navigating the Market Safely. Let's talk strategy and action. Because understanding all of this data is really only useful if you know how to actually apply it, right? The breakdown of the 60K level fundamentally shapes how you must navigate moving forward. First things first, avoid aggressively buying into short-term price spikes. Remember those false rebounds we just talked about? Instead, reduce your entry risk by splitting your cash into smaller tranches so you can buy gradually during a downturn. If you hold active trading positions, you absolutely must place your risk boundaries below that definitive support level of 57,790. And crucially, keep an eye on non-crypto data. Things like U.S. labor market reports and energy-driven inflation figures directly dictate whether broader market capital will actually return to risky assets like Bitcoin. You also really need to be aware of systemic risks hidden inside the network itself, like miner capitulation. Extended periods below 60K put immense financial strain on smaller Bitcoin mining operations. If the price stays low and operational costs start exceeding their mining rewards, well, they aren't selling because they want to, they're selling because they literally have to, just to keep the lights on and pay the electric bill. This forces them to dump their Bitcoin inventory onto the market, creating a massive, unexpected wave of new selling pressure that can completely blindside traders who are relying purely on order book data. But the ultimate reality check to keep in mind here is macro environment dominance. You can draw absolutely all the technical support lines you want on a chart, but they just cannot withstand heavy macroeconomic shocks. If global inflation spikes drastically, or if geopolitical conflicts suddenly worsen, technical support levels will fail, regardless of how strong they've been historically. The chart is entirely at the mercy of the global economy. Which brings us to the final and really the most provocative question you have to ask yourself as you watch this breakdown unfold. Will these technical floors we've identified actually hold, or will the turbulent global macro environment dictate the ultimate bottom? Keep a really close eye on the data, stay disciplined in your approach, and stay safe out there in the markets. Thanks so much for joining me for this explainer, and I'll catch you next time.